Hey guys, what's up? Welcome back to another video. So in this video, I'm going to be talking about a certain tool that I use in my trading. I've been using this tool for 6 years now, and whether it's on XAU, USD, GBP, JPY, it works across various pairs. So I'm going to be showing you guys how I apply that tool. And by the way, that tool is called Fibonacci retracement. You guys are probably familiar with it. A lot of people, they use Fibs in trading, whether it's for structure, whether it's for hunting levels, whether it's just for knowing, which zone you're trading in. So I have a certain way of trading with Fibs also, and that's what I'm going to be showing you guys in this video. So, on Fibs, we have the 23.6, we have 38.2, 50, 61, all those various levels that I'm going to be showing you guys. And, personally, I think that every single level tells a different story, And, there's different ways to use these Fib levels. And if you know how to use them to the best extent, I really think that you can make the most of your trading. Whether it's catching more pips, whether it's cutting losses quickly, every single Fib level tells a different story, like I said. But without wasting time, let's get into it. All right, guys, so we're going to get started over here. So I'm going to show you guys, first of all, how I apply the Fibonacci. So it's pretty simple. I think I've spoken about structure in one of my previous videos. This pattern right over here, is the one that I look at always. And like I said, when price comes down and forms a support and it breaks the high, the odds are that it's going to go up as this high over here. Sorry, I didn't put it straight, but when price makes a high, it comes down, it's going to go test that high once again. So anyways, I'm going to apply that over here on my Fibs. I'm going to take the low over here. I'm going to go all the way until the high over here. So this for me is a valid Fib. The same thing, I'm going to do it over here. I'm going to take my low over here and I'm going to apply it to my high over here. And you guys are probably thinking that, why didn't I put it over here? Why didn't I put it over here? And the truth is that these are valued Fibs also. If you were to put it over here, like this didn't quite tap the 38.2. Oh, it did. Okay. It was really, okay. It didn't quite tap. So I would extend this a little bit more. If it were to tap, yes, it's a valid Fib because the 38 itself is a valid Fib. But I'm going to be extending this over here. This didn't tap the 38 either, so I'm going to be extending it. So basically what I do is I keep extending the Fib until it taps minimum the 38. And what I do sometimes also is that even if it does tap the 38 level, I'm still going to extend it. Because for me, a real retracement is a minimum of 50. And yes, I do take trades off the 38, but a real retracement has to be the 50 at least. So this Fib over here is valid. You can see we came to the 50 level right over here. And look at the instant rejection we had on it. So I'm going to place another Fib over here. You can see we have this Fib here as well. And you can see, look at the rejection off the 50 over here. And you could have taken it off this low over here also. It would have been valid also. And this was a 61. So, the truth is that when we're trending or, in any type of market, there's always one level that is going to snipe, whether it's the 50, whether it's, your 38, 26, one of these levels is going to snipe. And your job is to figure out which one is it. And, I don't always enter blindly off snipes. Like, I always wait for, a support to form. Like I said, like I showed you guys the certain pattern, the support is going to form and then we're going to go up. But sometimes, it could happen that I snipe the trade. Like I take the trade off the Fib level. And for that, I have to see multiple confluences, whether, it's an MA, whether, it's a psychological level, a key level, whatever it is. So I'm going to be showing you guys all of these levels. And like I said in the intro, every single level for me has a different meaning. It's a different story on every single level. So I'm going to start with the 23.6. So the 23.6 for me is a very aggressive level, meaning if price is going up, this is the level that, when price is really excited, then it's going to come down and shoot up. Like you guys probably saw this happen many times, when there's tensions going on and, the market, well, gold especially is really excited. It's not going to come back all the way until the 61 or, 50, 78. What it's going to do is that it's going to go up. It's going to do a small pullback. It's probably going to range and then it's going to go up. But in that range, it's going to tap the 23 level. So that for me is the 23.6. Now you have your 38.2. So your 38.2 is kind of the same thing as the 23.6, meaning that it's a level where gold is going to go when the market is really excited. But I prefer the 38.2 as compared to the 23.6 because the 23 is really, really, really aggressive. Like 90% of the time, it's going to go until the 38.2. And what it might do is that it's going to go to your 23.6. It's possible that it shoots up, but it's going to, like range a bit and go up a few pips, and then it's going to go down to your 38, and then it's going to go up. So I prefer the 38.2. If I'm looking at intraday moves and I'm looking to catch, a few pips, and I get the confirms off my 23 or there's confluences, I might snipe the 23 or take a trade based off that. But most times I'm going to be looking at the 38.2 when the market is really aggressive. So we can take a look at a few examples over here of when the 38.2 got hit. So there was one right over here this week, actually, March 14, last Friday. So if you take a look at this over here, you take it from your low to your high. So you see over here, the 23 did snipe initially, it gave a few pips like we said, but initially after that it came back to the 38.2. So as you can see over here, really, really nice reaction off 38. And you go down to your smaller time frames, you can see the same thing. Support gets formed over here, goes up, comes down, but it doesn't quite take this low out, meaning this is a strong low now. So when support forms over here, you can look to take buys to go up eventually after. So like I said, 38.2 really aggressive level, but I prefer the 38.2 over the 23. So now we're gonna go to the famous 50 retracement level, and the 50 is the most famous level for sure, because this is the level where all the retail traders are going to be looking to enter, whether it's the 50 or the 61. But it is the most important level also because even the institutions, they're looking to buy at a good price most times. And what's a good price? A good price is always below equilibrium. So 50 is the half, basically, between 0 and 100. So once you're trading below the 50, for institutions, you're looking at a really, really good price to buy. And you guys probably know the phrase, buy low, sell high. So when you're buying below the 50, you're looking at a good price always. It's not the best price because we do have the 61, the 78, the 88. But once, it reaches the 50, it's a really good price. And in trending markets, when gold, is bullish, it shouldn't go below the 38 and the 50. Like sometimes you'll see it go to the 61 maximum. And, that's going to happen maybe 1 time out of 5 in a really, really bullish market. But, most times your 38 or your 50, they're going to hold really, really solid. So we're going to see over here if we have a few more examples of the 50. We must have, because, the 50 is a really famous level. This one, I think it was a 61 over here, was it? Yeah, this was a 61 over here, and you guys see the snipe over here. But if you were to take it, from the bigger fib, then this must be a 50 over here. There you go. So this is a 50 snipe. I'm going to go see if we have any other examples. Take a look at this level over here. This was a 50 also. Very nice. So you see it's a super bullish market. The 50 is a pretty aggressive level also, but it's a perfect level when you're looking for, equilibrium and aggressive at the same time. So as you can see over here, it came really, really close to the 50. Didn't quite tap because, the market was really bullish and, it made its way up after. So that's the 50 level for me right there. Now I'm going to go ahead to the 61.8. And, this is one of my favorite levels right over here because this is what you call the sniper level. So 61.8 for me, this is a level where I'm not really going to look for confirms, I'm not going to wait to see. Yes, I can take it off confirms also if I do get some, but generally when you're talking about 61.8, this is a sniper level right over here. So when you combine this with market structure, with, like I said earlier, your, whatever it is, your trend line, key level, psychological level, whether you have your 100 MA, 50 MA, a supply zone, demand zone, any kind of confluence that you want, if it's aligning with your 61.8, in a bullish trend or, in a really solid trend, or you can see, price action moving well, it's gonna snipe most times. And you know, we took a look at the level earlier. I believe it was here. So if you guys place this fib over here, you know, you can see your MA is a bit below. You know, you're trading at close to 2775, 2770, you know, really close to those levels. And you know, you probably have this zone over here also. You know, it didn't quite come to tap, or did it? No, it was really close. But nonetheless, you know, you have a few confirms over here. And if you dig down to the lower time frames, I'm sure that you have more confirms over here. But you know, this right over here is a sniper level. And as you can see over here, you know, no drawdown over here. So this for me is a really, really strong level. And if you're entering over here with all those confirms and you know, price starts to leak below, then you know something is wrong. You know, you can easily manage risk. Like I said in the beginning of the video, you know, not only it allows you to enter trades, but it allows you to manage risk also. Like if you know on the 61, you know, it's your sniper level and it's starting to leak and close below, you know, something is wrong. And I'm not saying that, you know, leakage is not possible. Like you see over here, you know, it did leak like maybe, you know, a few pips over here, but you know, it could go and grab liquidity. Like it could possibly leak all the way until here and then shoot back up, but it shouldn't really close below and give more bearish signs beyond the 61 if you have all your confirms. If it is, then you know something is fishy. So I'm going to go on to the next level over here, which is a 78.6. And this level over here is what I call the institutional level. So, you know, this level over here is when the institutions, you know, they're not really aggressive in their move. You know, they're making more passive moves, but at the end of the day, you know, they still have their agenda of where they want to go. And this level right over here is the one that, along with the 88, is one that, you know, is going to take out a lot of retail traders, because, you know, traders are entering here, 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 and they're putting their stop loss over here, right? Because if you're taking an entry, let's say at the 50, you know, your stop loss below the 78 is now, you know, if you're looking on an H4 scale, it's 320 pips, which is insane. So, you know, traders possibly have their stop loss, you know, if they're targeting a 1 to 2 or whatever, you know, 1 to 2 right over here, then they're possibly going to put their stop loss, you know, as tight as possible. So what institutions are going to do is that they're going to push price beyond these 3 levels, these 4 levels. They're going to go to the 78 and you're going to get a big bounce and it's going to go up. Or, you know, what it's going to do is that it's going to come down to your 38. You're going to get a small reaction. It's going to go to your 50 or 61. You're going to get another reaction. It's going to bait everyone. And then it's going to push down over here. And then, sorry, over here to the 78. And then boom, one shot, it's just going to go up. So this is a really, really famous pattern. You know, I've seen it happen countless times in the market. So you guys are probably wondering, like, if that's the case, you know, they want to take out traders, then where should I enter? Is it the 38? Is it the 50, 61? And I'm going to tell you guys, it really depends on market conditions. You know, with experience, you guys are going to know which level is really the good level, you know, depending on what's happening in the market, what's happening, you know, fundamentally. Like I said, you know, the 38 is a really excitement level along with the 23. So if, you know, in a really, really trending aggressive market, if you're waiting for the 78, it's never going to happen. You're going to wait your whole life. So this is only going to happen when, you know, there's not much going on fundamentally, but gold still wants to keep a, you know, a bullish stance. So 78 right over there. Now we're going to go on to the 88.6. So this is the level where traders, you know, they place their stop loss. And, you know, I've seen countless videos on YouTube of traders who say, you know, enter on whatever they call this, the golden zone, and place your stops below the 88. And, you know, the institutions, they know that. But to be honest, when it goes to the 88, you know, most times, like I'd say 70 to 75% of the time, it's going to hit your stop loss, which, you know, the 100 is breaking structure, right? Because you take your fib from structure to structure. But once it hits the 100, you know, that's your stop loss right over there. But what it's going to do is that sometimes, and I say maybe, you know, 15 to 20% of the time, what it's going to do is that it's going to push it all the way until the 88, and then it's going to bounce up. And, you know, it's unlucky, you know, you got to play your odds. Like I don't really take trades off the 88 because, you know, I really believe that the odds of it, you know, when it goes over here, the odds are that it's going to hit your stop loss, because it's really, really, it's a deep retracement, right? But you have to realize that this level over here, you know, I wouldn't place my stop loss over here, to be honest, because it's possible that, you know, it couldn't push down until there, and still, you know, it's like, it's not breaking structure, but it's going to stop you out, and then possibly it can go back up. So what I do, you know, to manage my risk, no, I'm not going to enter at the 50 and, you know, place my stop at the 78 or 88 or below the 100 even, because, you know, that's a really, really big stop loss right there, right? What I'm going to do is I'm going to see each level, how it reacts, and I'm going to place a tighter stop loss on the lower time frame. I'm not going to enter right off the higher time frame. I'm going to dig down to the lower time frame, and I'm going to try to find the best possible entry using my fibs once again on the lower time frame. And I'm going to get a tighter stop loss, but most times, you know, I'm still going to target the higher time frame zones. So this zone over here, this zone over here, or, you know, further extensions. And like I said, you know, you guys don't have to really copy the same settings that I have. A lot of people, you know, they have different settings on fibs, but for me personally, you know, these are the settings that I use. So yeah, that was the 88 level. You know, it's a stop hunt level 15 to 20% of the times. But, you know, if the trade is going over here, then generally, you know, it's going to hit your stop loss. So this level over here, you know, I don't really mind it much. You know, if I see confluences here, I would possibly enter a low risk trade. But, you know, once again, like I said, I don't really expect much happening at this level over here. And finally, we have these two levels over here, the 27 and the 61. So these, you know, for me, this is your take profit extensions. The 27, first of all, is a level where I'm going to target a lot. And this level for me is going to be when, you know, there's not really a fundamental reason. You know, it's mostly just a technical trade. You know, I'm not looking to go that far because, you know, sometimes what it's going to do is that it's going to go to this level here. You know, it's going to range a bit, reject, and then it's going to come down all the way back to your entry. So, you know, I don't get too greedy, really. I really pay attention to what's happening fundamentally. And, you know, this is just a technical move for me. So I might enter here somewhere 50, 61, you know, hold all the way until here. You know, that's a good, wow, you know, on the H4, that's a crazy move right there. You know, that's 700 pips right over there. So like I said, if there's no fundamental reason, it's a pure technical trade, then this is a good level. If you're looking to go further and there's a technical trade supporting, there's a fundamental trade supporting your technical idea, then, you know, I would look to go further, 61 or, you know, 127. But these are really, really, you know, big swing trading levels. So I'm going to take a few examples over here. I'm going to go on to the daily time frame over here, or the H4 even. You know, there's some nice levels on the H4. So this is a trade that I caught last week. I had this fib over here, and this was post CPI. You know, we went over here, we grabbed liquidity, breaking these lows over here, you know, stopping out a lot of traders. So, you know, I did get a rejection over here at the 50, a really nice rejection. And that told me, you know, I had my MA also below. So this told me that, you know, there's something possibly happening over here. So after we got the confirms, I did enter longs over here, which, you know, I held all the way until here because I wasn't sure of CPI. But once, you know, we got the fundamental reports and everything, I did hold this trade all the way until here. My stop loss was about, you know, I entered on the lower time frame. My stop loss is here somewhere. So this, I took it on my swing trading account. You know, it gave, you know, as you can see, you know, a big amount of pips right over here. So this was a really nice trade, and look how much time it took to hit it. It only took 2 to 3 days. So you can see, you know, it reached this level over here. There was a bit of reaction over here. This level right over here, you know, it blew through it because, you know, fundamentally we were super bullish. And, you know, as you can see, price is still continuing over here. And, you know, it's possibly going to go further up. We do have FOMC coming up, but, you know, all these levels over here, you know, you can use them as different take profit extensions, you know, depending on what your fundamental analysis is. So that's how I use my fibs to, you know, catch the maximum amount of pips that I can, or, you know, whether it's to minimize my losses, you know, manage my risk. So, you know, don't blindly enter off fibs. You know, I know a lot of people out there, they say, you know, just blindly enter off the 50, 61, you know, don't put a stop loss, or, you know, put your stop loss, you know, super tight to the 88 or whatever. Like, institutions, you know, they know this stuff. And the most important thing is that you know what's happening, you know, the perception of the market, you know what's happening in the market, you know, what kind of market conditions are we trading in, and really align your fundamentals with your technicals. And that's going to help you, you know, maximize, you know, your win rate and the amount of pips that you catch. Thanks for watching, guys.